Hey everyone, this is Kirk here again at OptionAlpha.com and welcome back to the video recap. It's actually the weekend on Saturday morning, so I'm recording this video after Friday's close. But what an interesting week we had, right? The market was kind of all over the place. And for Friday, we actually had 3 new opening orders and then 3 closing orders that we closed out for a profit. So we're starting to get a little bit more movement in volatility, which is definitely helping, and that's obviously the case because the markets all closed near their lows or at their lows on Friday. And we had just a huge move lower, which is now spiking volatility across the board. So our plan, as always, is to continue adding positions. We have some positions that are losers. We have some positions that are winners that we're holding on to. But as always, we want to keep adding positions and then start rolling off positions as we get closer and closer to expiration. So if a position turns into a profitable position, then we'll roll it off. And if not, if it's a risk-defined trade, we'll continue to hold that position as long as we need to, all the way up until expiration if need be, until it shows a profit. So before I actually go to the charts, or go into the trades, I want to go to the chart here of Thinkorswim and take a look at the Qs, because the Qs had really a rough day on Friday. And you'll notice what has been happening kind of psychologically in the market. And while I don't go over this a lot, I go over this more in my one-on-one coaching with the premium members. But I do want to cover it with you guys here. But you'll notice, obviously we know about this huge rally that the market had back in February and then the beginning of March. But what's happened since has been really interesting, right? So we had our highs at 91.36, right? That's where the highs on the Qs topped out. And then after that, we had this quick dip, and it almost kind of broke the recent support area that we had back from early March. So kind of had this quick dip, and it seemed like it was going to retest this area of support and then continue higher. But then right after that, we had this day, which was really the last day of expiration for March. And that day was a pretty powerful day, right? We opened higher on the day, but we actually closed at the lows and kind of engulfed all of these profits that we had built up over the last 4 days. So that obviously continues to send the market lower after that. And we did find, again, support right around the end of March and had since popped up, right? And so everyone is getting a little bit more bullish, right? Us included. We added some more bullish positions. We took some of those off, took profits, etc. And then here comes today, Friday, right? And we get the same type of mentality that we had back at the end of expiration in March, right? Just a huge, powerful red candle. We opened up higher than yesterday's close, but then ended up closing much lower and just kind of engulfed this whole area. So you can see kind of the edges of the candle just really took out so many days of progress and work. And now the market's not really used to that, right? So what we usually see is the opposite happen. We usually see the market having these powerful, strong up days, right? Where they're taking out lost days. But right now we continue to see a trend of lower highs. So we get lower and lower and lower highs, and lower and lower and lower lows. And that's obviously not a good trend right now. Well, for options traders, that's great, right? We like implied volatility to be high, but for the general market, that's obviously not a good trend. And the fact that we continuously cannot push the barrier higher and we are breaking new lows every single time, that's obviously continuing or signaling that we're at least heading back in the downward direction near term. So I would think, at least for the Qs going forward, that our next area of support is going to be around 84, right? That's where we had a major bounce before. So we're likely to see some more buyers come in to that level. But right now, people are kind of bailing on stocks. And so that's creating a good opportunity for us for new positions that we're adding and getting rid of. All right, so let's go over the closing trades that we had for Friday. So the first one is AXP, and AXP is one that is for April. So the other ones are Oracle and Pfizer, which are May. But AXP is April, and AXP, we took a very small profit in this. We had originally sold the 92.5, 95 call spread and bought it back on Friday for a 30-cent debit. So it was only one lot trade, meaning that was only one vertical spread that we had sold and one that we bought back. So very small profit of $35, but still continuing to do what we always say we do with our strategy, and that is with these credit spreads, that we are closing them out at about 50% or 50 to 75% of max potential gain. So we sold this for 65 cents. We bought it back for 30, so it's a little bit over 50% of max potential gain. Really, the idea with AXP, I guess, along with the general market, is that stock continued to move lower and implied volatility dropped. So as the stock had a huge down day and continued to break lows, then that obviously helped our position because we were at the 92.5, 95 call spread, so just above the market. Now, we could have obviously held this thing a little bit longer if you wanted to. So if you had more than one position, we only had just one contract that we were trading. But if you had 5 or 6 or 10 contracts, then this is a great example where you could actually just kind of slowly get out of the position. So slowly roll your contracts out. You get rid of 1, then 2, then 3, etc., and just kind of leg out of the position slowly. But seeing as we only had just one contract, we just exited it completely. The other trade that we got rid of today is Oracle. So Oracle, I believe we only had for about 3 or 4 days. So this is a trade that we made in the beginning of the week where we had bought the 42 strike puts, sold the 41 strike puts. We paid about 49 cents for that credit or for that debit spread that we had originally bought. And just anticipating a drop in Oracle given that it's gone so high recently. And we got most of that move already. So if you look at the width of the strikes is only $1. So that's the max potential gain that we can make on this trade. And seeing as how this is originally a 50-50 bet, we have already made $21 of that max $51. So originally a 50-50 bet, we really, these are kind of shots in the dark. It's more of a directional trade. So you do want to exit these a little bit earlier than some of the credit spreads, right? You don't want to let this thing go all the way to expiration and try to get every little ounce of profit out of this. If we can get rid of it fairly quickly and with a decent profit, that's what we're going to try to do. Again, I believe we were only in Oracle for a couple days. This was not a trade that we were in very long. And you can see exactly where we entered this trade. We entered this trade, I believe, right at the high, so it's just really good luck and timing. But you'll notice, and if you go back to the video tutorial, for those of you who are members, you can see all of those inside the Option Alpha platform, that the reason that we entered this was purely because of the move up, that it had just so many consistent days higher, and implied volatility was low, so that allowed us to do a debit put spread versus selling a call spread or selling other types of option strategies that take advantage of drops in implied volatility. The other trade that we got rid of is Pfizer. So this is one that was originally a put spread that we bought back. So we bought back the 31.29 put spread for a 30-cent debit and took in a $26 profit on all of those. Forgot to mention on Oracle, we had a lot of these contracts. So we actually had 5 verticals that we had originally bought. So the $21 profit, although it seems small per spread, was actually a fairly decent profit for the actual position. For Pfizer, the name of the game with Pfizer is that implied volatility dropped, the stock moved up, which helped our positions because we were bullish on the stock, selling a vertical credit spread below the market. We go to the chart of Pfizer, you can see exactly what happened here. Notice that the stock continued to move higher. Implied volatility actually dropped a little bit and is still very, very high in Pfizer at 89%, but that move up in the underlying stock actually really, really helped us. We actually got out of this position near the highs of the day, so that helped. It actually turned back around and turned over as we headed towards the close. But again, with this position in Pfizer, it's really, really important because we had a nice credit in Pfizer, right? We had a decent credit, and we just wanted to get rid of that by buying back the stock at about 30 cents. All right, let's go over some of the opening trades here today. Got a lot of questions on Pandora and Baidu. So Pandora and Baidu are actually positions that we currently have for April expiration. So in Baidu, we have a very, very far out of the money at this point call spread that we had originally bought near the highs of the market, and again, just needed some positive delta. So really didn't anticipate that thing to be a major winner, but we do have that position. For Pandora, we actually have an Iron Condor on for for April expiration. So April coming up, we have an Iron Condor on for Pandora. Now, I get a lot of questions about this. Why, Kirk, did you add a position for May? And in most cases, you want to take a look at positions that are in the same contract month as being paired or similar. So in Pandora, for example, we originally sold a put spread, and then we came in and sold a call spread against it. So now we have an Iron Condor, but it's all in the same month or in April. As we look out towards May, I'm treating this as an individual new position. So the reason I wanted to get into both of these securities is because their implied volatility is so high right now, we just can't shy away from it. The positions that we have in there are what they are. And especially for Baidu, it's so far out of the money, I'm not even including it as a position right now. It's just out of the money. It'll probably be a big loser on our end for that one position, but it's so far out of the money right now, and they have to start building more positions for May. So with Pandora, what we did is we went in and sold a vertical credit spread above the market, a call spread. We sold the 30 strike calls and bought the 31 strike calls, took in our usual credit of about 30 cents on a $1 wide spread. If we go to the chart here of Pandora, you can see that it's obviously having a really, really tough time lately. Pandora and Baidu and a lot of these other ones, Chipotle, Yahoo, IBM, LinkedIn, etc., were down big time on Friday. And so as it continues lower, we just went in and sold the 30-31 call spread above the market, just trying to take advantage of some of the implied volatility here. So you can see it's at the 68th percentile, which is very, very high for this. So allows us, another opportunity just to take advantage of the market. With Baidu, we went in and sold another call spread above the market for May. It was the 165-170 call spread this time, so it's about a $5 wide call spread. Means we took in a little bit more in credit. We took in a $1.15 in credit for each spread that we sold. Again, with Baidu, we have a position currently for April expiration where we are long calls up here near the top of the market. So you can see that those are just obviously way, way out of the money, but we're going to keep them because they're a lottery ticket. And that's what I've continued to tell people is we're going to keep these things for sure because they are a lottery ticket against the market continuing to move just rapidly higher, right? Who's to say that Baidu doesn't make another one of these moves that it had just a couple months ago where it just shoots back up towards the middle of the month and ends the month very, very high. So we're going to keep that position because it's basically worthless anyway, so it is a lottery ticket that we're holding. But that doesn't mean that we can't add positions for May expiration. So our first strike is at 65. That's basically our line in the sand of where we want Baidu to stay under, at least for May expiration. And obviously implied volatility on Baidu as well is very, very high. It's at almost the 70th percentile. So this leaves a lot of room for us to move away from the market and get great pricing and great premium. You'll notice with Baidu how far we got away from the market here. So we're almost $15 away from Friday's closing price at 149.35. So that really, really helps our position to move that far away from the market. If Baidu does rally up even $5 or $10 and implied volatility drops, we actually could have a position that shows a profit very early just purely on the drop in implied volatility. So this is why it's so important to be on the right side of that volatility move. Now, the last position that we entered today was in OIH. Now, oil has been one that I've had on my radar for quite a while, and it just continues to move higher and higher and higher. But as we started to see more of the equities roll over on Friday, I decided to get into this oil trade and take advantage of hopefully a drop in oil as well. So what we did is we went in and we bought the 52.49 debit put spread in OIH, which is just an oil ETF. We paid a little under the mid price of this, and this is just to give us a little bit of room and also to match up our break-even price with where oil was actually trading. So when we trade these debit spreads, we try to get a break-even price that's very, very close to, if not very similar to where the actual underlying is trading at the time. So if in this case we wanted to get the break-even price very close to where oil was trading when we actually entered the trade, and this gives us more of a pure 50-50 probability if our break-even is right at market price. So if I go here to the chart of oil, you guys will see exactly what I mean, that all of these oil stocks just have gone through the roof in the last couple weeks and just seems like it's a non-stop choo-choo train of moving higher and higher for a lot of these oil ETFs. Now, if we take a look at here, oil just a little bit closer, you'll notice that the biggest thing, and this is really the reason, kind of the signal that I got here today of why to get into oil now, at least on the bearish side, is because of this huge shooting star pattern. So oil was actually up at 51.24 today, which is a pretty substantial move in this ETF for one day, and had opened low, had rallied all the way up to 51.24, and then had come all the way back down to close lower on the day. So that really just shows the market sentiment, that people were buying it in the morning and dumping it in the afternoon, hand over fist. So that really kind of proves the point that maybe we should see a little bit of a drop here in oil in the next couple of days. Again, since implied volatility is only low at the 14th percentile, we're not going to be selling any credit spreads. We're not going to be selling any option strategies. We're just purely buying a debit put spread to take advantage of oil moving lower. So we draw a line in the sand right at the current price of where oil is, and basically we want oil to trade anywhere in this bottom range between now and expiration. That gives us a great opportunity to take profits on this trade. So this is a really high probability trade in my mind, even though it's a 50-50 shot. Theoretically, I think this is actually a good probability trade, which is why we entered it and sent it out at the end of the day. So as always, hope you guys really enjoy these videos. If you have any comments or questions about any of the trades that we made here or any of the closing trades as we get closer towards expiration, please add them in the comment section below this video. Have a great weekend, and we'll see you guys on Monday.